Speaking of investments, Indian markets are on a high. The Nifty 50 touched an all-time high today. This is the index that tracks India's top 50 companies. It has crossed the 26,200 mark. That's the highest it has ever been. Later in the day, the index cooled off a bit, but the overall sentiment seems positive. And it's being driven by three key factors. Number one, the earnings of India Inc. Indian companies have reported strong results. This is for the second quarter of this financial year from July to September. India Inc. has reported growth in profits. And this good run is expected to continue. Experts say profits will grow in the months ahead by almost 16% in 2026. So that's the first positive, the growing earnings and profits. The second positive are the GST cuts. GST stands for Goods and Services Tax. It's the consumption tax in India. In September, India slashed this tax substantially. Taxes were cut on 99% of the goods, and investors have reacted positively to this announcement. This tax cut, this GST cut, has given businesses breathing room. It has also made a lot of products cheaper. Investors feel this will help the economy grow. Reason number three for the market surge are the foreign investors. After months of pulling money out, they're coming back. In October, overseas funds became net buyers of Indian stocks, meaning they bought more than they sold. They were net buyers. They pumped in $1.3 billion. And that's a significant reversal. It signals growing trust in India's market outlook. The question is, will the momentum continue? What does 2026 look like for Indian markets? Will this rally lead to a bull run? American bank Morgan Stanley believes it will. They expect India's Sensex to breach the 100,000 mark, 1 lakh. And by the end of 2026, they say the Sensex will hit 107,000. The Sensex tracks India's top 30 companies. Today, it's at 85,000. Morgan Stanley says it will cross 1 lakh in the months ahead. That's a bold call. So what's driving this projection? Again, the earnings of India Inc. Morgan Stanley is optimistic about their numbers. It believes profits will continue to grow. But beyond that, they're buying into India's long-term growth story. The bank believes that India has the potential to sustain this growth momentum. Again, there are three factors that feed into it. One is rising private investment. Two, better finances of banks. And three, a steady inflation rate. Together, they will keep India's growth stable. That is Morgan Stanley's assessment. They're also counting on what they call a structural reset. And this is very interesting. They say India's domestic investors are driving a shift. They're investing in larger numbers through mutual funds, through retirement funds, through direct investments. And this is reducing India's reliance on foreign investors. This is a structural shift. It makes Indian markets more stable, more predictable. Of course, there are still some risks. External pressure points that could impact domestic numbers, like a slowdown in the US, or rising oil prices, especially if prices cross $100 a barrel. Or geopolitical tensions. If tensions escalate, they will have a bearing on Indian markets. But like I said, most of these are external risks. Inside India, the fundamentals look strong. So is this the start of a new bull run? It could be. India's stock market is sending signals of strength. The earnings are up, investor confidence is back, so is foreign money. Only this time, the story is a little different. This time, India is not just riding the global wave. India is building resilience from within, and that is showing in the stock markets too.